The share of the U.S. apartments owned by large investors really hasn't changed that much over the last
Mm.
couple of decades. Now, the share that's being managed has indeed seen consolidation. So I think what we're seeing is efficiencies of scale in managing it, but not so much in owning it.
Hi, this is Matt Sleppen, and welcome to Leading Voices in Real Estate. Today's episode, recorded on April 10th, is a conversation with Jay Parsons, host of the Rent Roll podcast and a leading economist and commentator on the multifamily sector. Jay and I have a wide-ranging conversation about the apartment business and adjacencies like SFR, BTR, and student and seniors housing. Jay shares his thoughts on the state of these markets, trends, current legislative and regulatory challenges, and some of the common myths that he likes to bust about these sectors. Although we're wide-ranging across real estate sectors, disciplines, and now across the globe on Leading Voices, at my heart, I'm an apartment guy. So I love talking with Jay and getting his perspective. And just also recorded the next episode with two of the key leaders at Built, the hospitality platform for housing, about their impact and adoption within the apartment industry and with our customers, the apartment renters. We so often talk about the business side and rarely focus deeply on the renter experience, which is where Built is doing their work. Awesome conversation, and stay tuned for that one in about 2 weeks. Jay has spoken about this frequently and explores it on his podcast, which I encourage you to check out. But I think, spoiler alert, that the most interesting myth-busting for me in the conversation is that the multifamily business from an ownership standpoint, irrespective of the headlines, remains a highly fragmented business. I talk all the time on the show about the march during my career towards greater sophistication and institutionalization in the apartment business, and I thought that coincides with consolidation from an ownership standpoint. But as Jay points out, there has been substantial consolidation on the property management side, with Greystar as the exemplar, but ownership remains fragmented, and we have the NMHC Top 100 as a tool to track that historically. How we think about that, low-ish barriers to entry from an investment standpoint, but size and scale mattering more and more operationally, is important food for thought in this business. If you'd like to learn more about ZRG and how we can help you in your real estate business through retained search, interim search, embedded recruiting, business consulting, and advisory, please connect with me at msleppen@zrgpartners.com. When I sold my company, Terra Search Partners, to ZRG back now 4 years ago, ZRG was then the 11th largest global talent firm. We're now 6th, with really broad and innovative capabilities for our clients, and I'm happy to chat. If you're enjoying the podcast, I encourage you to explore the archive, now over 220 episodes, which you can find in your podcast app or via the ZRG website. Please subscribe, rate the show in your podcast app, and definitely share some of these episodes with friends or colleagues. I hope that you enjoy this conversation with Jay Parsons, and stay tuned for the Built conversation in the back-to-back explorations to the apartment business this month on Leading Voices. Wait. I recorded this introduction yesterday, and this morning I woke up to a news alert, actually from Jay, that there's a rumored potential merger between EQR and Avalon Bay. By the time you hear this podcast next week, we'll have a better sense if this is real or not. But it's big news, obviously, and from my perspective, even the rumor changes the landscape, since the apartment REITs have so long been in a bit of the penalty box, at least in terms of discount to NAV, and consolidation among these companies might be part of the answer. But as Jay says in his missive, this combination would not move the needle on the big picture that multifamily is a fragmented business from an ownership standpoint. But there's a huge opportunity from an operational and business platform standpoint that's in line with Jay's commentary on this episode, and also the Built conversation that really focuses on the resident experience. More to come in 2 weeks when I intro the Built discussion, but I could not let this discussion with Jay come out without mentioning this headline. Okay, now on to the conversation with Jay. Jay Parsons, welcome to Leading Voices in Real Estate. You and I have been trying to have this conversation for a couple of years now, and I'm thrilled to finally have you on the show. It's part of a 2-episode month on multifamily. You're the multifamily guru, and so I want to talk kind of wide-ranging across the industry. The next episode is with two of the principals at Built. So in each case, we're talking about multifamily. I want to talk about the economics of multifamily, the drivers of multifamily, the industry, the changes to the industry. Much of that I want to be as backdrop for the political environment and the regulatory risk relating to the apartment industry. So that's really interesting to me. I've been listening to your podcast. You've been talking about these subjects. You know a lot more about the drivers of the business than I do. So I'm just thrilled to have you on the show and looking forward to a wide ranging conversation.
Well, thank you for having me. I'm excited for the conversation.
Cool. So I called you the guru. Tell me what it is you do, or tell your audience what it is you do, who you are, just a little bit about your business and your platform.
Sure. Well, thank you for the kind words. I definitely don't. I'll appreciate the compliment there. Yeah. So my background is I started in rental housing research back in 2009 as a research analyst, writing really boring reports. And didn't have plans to stick around doing it very long, but kind of fell in love with the industry, the myth busting element of it. And so these last two plus years, I've spent in a handful of roles, but really kind of sold out into working as a consultant, advisor, speaker for both apartment owners and operators, developers, lenders, policy folks as well, but also on the single family rental side and build to rent. So, I try to be helpful wherever I can be helpful.
Cool. We're definitely going to talk about SFR and BTR, which are under attack right now
Yeah.
in federal policy, and that's likely to ease over into multifamily. So they're adjacent, and it really matters. But you said the term you like to be a myth buster. What does that mean?
Yeah, no, I like to do things that are, I like I mentioned earlier, my first job was writing research reports, and the worst, everybody's read the reports and honestly, these reports, the type of reports, they're just regurgitating facts. Like, here's the data, right? That's not interesting. I'm always interested in what's new, like what's surprising. And one of the great things about rental housing that I find interesting is that so many of the embedded beliefs about rental housing, investors, and about renters themselves are really kind of grounded in misinformation or dated views. And so I'm always interested in the opportunity, whether it's whether it's a media or policymaker or investors or the public, whatever, it's taking a common point of view and challenging that with actual data and research, and it's very rewarding because ultimately, housing is important, it's essential, and I think if we're gonna all agree that it's important, it's essential within our decision making as investors or as cities, should be informed with facts and not misinformation.
And the best example for misinformation might be rent control.
But yeah, we go through all kinds of things. I mean, rent control is a good example of something that sounds good in theory, but has never actually worked. Ultimately, just backfires on the people it's intended to protect. And there's ample academic research on this topic, not just an industry point of view, but it's probably one of the most researched topics in housing. Um, and there's a lot. I mean, this whole single family rental ban. I mean, we could go on and we could spend a whole show just on myth busting.
Well, that's what we're going to do. And be aware that most of our audience, our listening audience, and probably same for the Rent Roll, your podcast, is the choir. So we're talking to ourselves about this. We luckily get to influence others. I'm always surprised by those who listen to the show and say, wow, I didn't know that, or I heard that. What are the myths that we have of ourselves? Any comments about that?
Oh yeah, absolutely. That's what actually got me started in this is like all of us in our careers, we have these moments that end up being kind of these defining moments that shape some of
Yeah.
the future decisions we make. For me, one of those moments was early 2010s, coming out of the GFC. I was sitting in an office in Manhattan with a very large institutional investor, and a senior executive made a comment. I was presenting about the state of the market across the country and presented a very bullish view on high growth Sunbelt markets across Texas and Carolinas, Florida, et cetera. And I remember this guy made a comment that, well, and I'm going to butcher the actual words, but it basically came across as, and it wasn't even, frankly, there was very little attempt to even kind of gently word it. It was very bluntly, basically, the only people who live in Texas and Florida are those who aren't smart enough or rich enough to live in New York City or
Oh my
LA
God.
or San Francisco. And particularly for young adult apartment renters who are upper income. And I remember thinking of that. And of course, at this point, like, I'm one of those people. I was living in Dallas. And then thinking to myself, it's like this doesn't reflect what I know. And and obviously at this point in my career, I'm pretty junior. And so I'm just kind of nodding my head and not, I don't really believe what he's saying, but I'm not really challenging him. And that really was the start of it. And so a few years later, I wrote a paper on basically making the case that at that time, And you think about the early 2010s, like there was a lot of focus on, hey, we want to be in coastal cities and we want to be in downtown areas because millennials, I remember hearing a baby boomer one time tell me at a conference that millennials, and speaking, I'm a millennial myself, and he told me millennials rather drink battery acid than live in the suburbs. And I think, I don't think that's true either. But that was the perception
Right.
of the 2010s period. And so I ended up doing a lot of work on this and really showing, number one, that it wasn't that coastal markets were bad. And in fact, today, I think they're obviously been very strong, but back in that time, it became so that just sort of everybody drinking the same Kool-Aid,
The
dancing the same music.
orthodoxy. Yeah.
Yeah, it ended up becoming overplayed, and a lot of the return there ended up being more about appreciation as opposed to income, meaning like it was a self-fulfilling prophecy. Properties were worth more just because people continue to perceive it was valuable, not because of underlying supply-demand fundamentals are actually stronger in that decade in the Sun Belt.
Mhm.
And then the same thing with like urban suburban. It wasn't that urban was bad, but that we were building so much supply in those downtown submarkets all across the country that they actually ended up underperforming the suburbs. And so that was from that, and there's other things we do today, but like those are the two things that early on sort of set me on a career of realizing, hey, like, I want to take data and challenge these kind of mainstream thinking and thought points.
I was at a ULI panel years ago, and the CEO of Gables was debating the CEO of EQR. Wheeler, was that the guy at Gables, I think? And Doug Crocker, I think. And they were debating, okay, we have a coastal strategy, and what's the value of a coastal strategy over the long term versus the value of a Sunbelt strategy, and supply constrained versus supply unconstrained. It's been an ongoing discussion. You just said exactly the same thing, just in really different words. And we'll talk about it through the show because one's up when one's down, and then they go the other way, and sometimes they're in the same place. But these are just the trends of the market.
Yeah, absolutely. And with EQ, I mean, I think both of those are, I think, a good example of what I love about this business. And frankly, like in my job, I get to speak to and advise and go to events and do consulting for groups with all types of strategies, like, from institutional investors who are coastal focused to big summit markets to tertiary Midwest markets to Class C West Coast. I mean, the reality about our business is that you can be successful doing 1,000 different things. And seeing a panel like that, like Gables and EQR, are some of the biggest names in our industry, and both have done well doing different things
Mhm.
with some crossover. And so I love that about this space. It's not necessarily one size fits all.
And it's also changed, and I've been at this a little bit longer than you. So I'm a baby boomer, not a millennial. So I've been in this for 40 years, 40 plus years around the apartment business. And the level of change I've seen has been humongous around technology, around consolidation to some degree, which we're going to talk about in a minute, around business platforms, sophistication, institutionalization. I mean, it's the property management was one thing then, and it's another thing
Yeah.
now. So the business has evolved so much. One of those, and I just read your post a few minutes ago about the NMHC Top 100, and I've assumed it's a march towards consolidation. And I think your comment is, well, it might have consolidated, but it's still one of the most fragmented industries in the country. Comments about that?
Yeah, that's another great example of something that I think is great myth busting. Like we see these big acquisitions, Blackstone acquires this company or that company, they acquire Air Communities. And so there is consolidation all the time. Like there's acquisitions of portfolios. But I think what people tend to underestimate is that like in other sectors, the barriers to entry are so high. Like other industries. If you're in like, telecom or the pharmaceutical business, I mean, the barriers to entry, grocery stores, the barriers to entry are so big, it's hard for smaller players become bigger players. The smaller guys can't weed it out. In our business, we see, even as some of the bigger guys see for consolidation, you have smaller guys doing the same thing. And then all of a sudden you have new players on that top 50 NMHC owners list that are now taking some market share. And so it all kind of balances out as a wash because it's really, really hard in our industry to get a lot of market share because the barriers to entry are actually pretty low as long as you got the money. You can outsource third-party management on day one, and you don't need any internal expertise to do it. The share of the U.S. apartments owned by large investors really hasn't changed that much over the last couple of decades. Now, the share that's being managed has indeed seen consolidation. So I think what we're seeing is efficiencies of scale in managing it, but not so much in owning it.
And let's play that a little bit further. When the public thinks of the renter universe, now I'm talking about tenants, but if the renter universe or the apartment universe, it's 4 plus. When we think of institutionally managed apartments, we're usually thinking of 100 plus units. How much of both the myths that we see in the public and then the myths that we have in our own business, are we talking about only institutionally managed stuff when you just said what you said about third party managers? And also, how does the public differentiate between these? Because we use rental housing as one word, but I think it's two different businesses, and the amount of 100 plus might be a third of the overall portfolio, but they don't know that.
Yeah, you're absolutely right. And I think it's even more broad than that. I mean, we have terms in the industry like Class A, Class B, Class C. We got affordable housing with a capital A, the true low income housing. You have the sub-institutional market, smaller, older multifamily buildings. You have the build to rent, which is a hybrid between apartments, single family rentals.
Right.
And obviously there's overlaps and shades of gray, but like there's a lot of nuance in these things. It's sort of like, if we're taking another fragmented industry, like the restaurant industry, and you're sort of saying, well, we're going to take Capital Grill and compare it to McDonald's. Like they're both food store, they both sell food, but it's a different business, a different customer base. And so certainly see the same thing there. And so there's some degree of that. But even if you look at just the Class A institutional market, it's still just incredibly fragmented, just again, because of the amount of different capital that wants to be in the space and the relative ease of accessing it. In terms of public perception, though, there's just so much cynicism right now toward, landlords. And I don't even like that word. It hails from the medieval era. Even the industry no longer has not been using that term for decades and decades and decades, but the Associated Press Style Guide keeps it in the vernacular. And certainly as do some of the older coastal cities where that term is more widely used. But there's so much cynicism about it that they tend to overstate. They see the biggest players and the big names, but they overstate their role. Like the reality is even in the markets they're most consolidated, they just don't have that much market share. Like I would be shocked if there's even more than a couple of places where the biggest player has more than a mid single digit, maybe upper digit share of the market, which is still tiny relative to what you'd see in other sectors. So I don't think the public fully appreciates just how fragmented this market is.
If I think of New York, and I read an article in the Times this morning about Mondami's first 100 days or whatever it is, the landlords are evil, but those landlords it's even more fragmented in New York because most landlords have 10-unit buildings, not 100-unit buildings. They're not institutional. And I'm wondering how the behavior of the institutional landlords differs from the behavior of the rest of the world, and how much of the landlord tropes are about those guys, not our guys.
Yeah, that's such a good question. And it's funny because I think, so let me zoom out a little bit. Like there's a tendency among the crazy conspiracy theorists to say, big investors are bad, small investors are good. But the easiest way to call the bluff on that garbage argument is look at New York City. Like most of the institutions barely have a presence in New York City, and they're non-existent basically, more or less, in the rent stabilization market, which is the, the affordable rent controlled market. And yet the rent, that's a mom and pop business. Even the biggest players are tiny, and it's mostly these older buildings, family businesses, as you alluded to. And the operating conditions there are really tough given the restrictions that they have. And yet, the mayor has started a series of what they call these rent rip-off hearings, basically lambasting property owners who aren't able to charge the rent needed to cover the cost of operating the building, and then criticizing them for not operating at a loss, and just finding a way to pay it one way or the other. So I think it sort of shows that it's really not about the size of the owner. It's really just this perception that there's a growing movement that says that it's just evil to operate a for-profit business for housing. And I sort of get the sentiment of that. But at the same time, I think we need to remember that if we don't have that, we're going to have less housing. It'll be more poorly maintained. And so, some of my YIMBY friends have taught me this. They say a lot is, hey, if you're going to have private investors invest money somewhere, why not invest it into building more housing and maintain existing housing? That's ultimately a good thing. It helps people get access to housing. And then, of course, you go from there. So I think that's really important to consider. In terms of the differences, though, I think the other thing I always hear about is people think that the mom and pops they act like they're all just happy to operate for no profit and just do it out of the goodness of their hearts. And that's also, I think, actually rather insulting to the small business. They're there. Yeah. That's their livelihood. They're not trying to operate at a loss. And so I think the reality is you have good investors, or what's called landlords. You have good ones and bad ones of all sizes. Thankfully, there's a lot more good than bad. The biggest difference, I think, is the larger ones. You have more efficiencies of scale, you're able to use more technology. You're probably able to offer more services to your renters that a smaller one just doesn't have the resources to provide. So, having full-time maintenance teams about to take care of issues, things like that. So I think there's certainly some advantages to larger ones, but I don't want to insult my friends who are in the smaller side because they can do some good stuff too.
Yeah, absolutely true. So let's keep playing through this one because it's really it's interesting for me to think about the differences of that and the public perceptions of that. And I say this on the podcast all the time, and you just hit the note on it, which is the word landlord and the word developer actually does describe our industry. And that's who we are, and they're bad words, and they don't need to be. But then it takes our industry leadership in the way of communicating and myth busting to not be seen as the evil folks. So it's a theme of the podcast. We talk about it all the time. So
No,
let's change the subject because this gets to the point that we're talking about here. There's a housing shortage, and a large part of the housing shortage is supplied by multifamily or by rentals. I see different numbers for the housing shortage, but I see 4 million, I see 3 million, I see 7 million. It depends. And I've heard debates about this, but that should be driving this business in a big way, even though there's a temporary overbuilding from the last cycle. So comments about what kind of the long-term prognosis, the housing shortage, and then where we stand in that cycle to get back to where we get to build and start solving this problem.
yeah, that's such a good topic, and it's a big one. That's one that I think is really misunderstood. I think it's crazy that you see. I think sometimes the media articles can make it confusing. Is the one hand you see an article that says we're short 7 million homes, and the next article says we're oversupplied, and developers built too much, and therefore rents are falling. And the reality is it's just more nuance than that, and we are undersupplied structurally. And so whenever someone says oversupplied, like I cringe a little bit because I think it's the wrong word. Like you have to kind of separate short-term dynamics versus long-term dynamics. The reality is that we do have a short-term supply demand imbalance because it's really hard to time supply to meet the demand when the demand is coming. And so supply always seems to be a lagging indicator. But you think about it, like I always equate it to if you have a city going through a drought and you open up a fire hydrant and turn it on, well, that's going to help where the fire hydrant is, that neighborhood, but it's not going to reach to where it's not going to. And at the meantime, you have a lot of excess water and you're saying, hey, there's too much water. We don't need this much water. Well, you do. It's not getting to the right places yet. And
Mhm.
also on the housing side, you're going to have people who are currently in temporary living arrangements with friends or family or in maybe a place they don't want to be in long term. And they're kind of waiting out the right time to make that move. And so that pent up demand is there, but it doesn't mean it just unleashes whenever that fire hydrant turns on, when supply arrives. So it takes time to figure out how to get that water, in this case, the housing, to where it needs to go. And in time, it's going to happen. It's just a question of when. So we are undersupplied. I think it's a nuanced story when you really look into it, though. A lot of that is going to be based on, certain, what neighborhood it's going to, the price points it's at. Obviously, the cheaper it is, the more supply we need. But, we're also seeing that when you build high-end supply, there's a filtering effect down market as well. So what the exact number is, I don't know, but I think it's somewhere in between the numbers that you see. I think it's somewhere in the 3 to 5 million range where we're still undersupplied in terms of all types of housing.
And if you think you just said this, but the trickle down effect of we build for the high end, then the older stuff gets down to the middle income people. The real lack of supply is for the quote unquote missing middle, which you can help me define here. But we can't afford to build for the missing middle. It's hard to come up with the product for that. Maybe it's just aged product works best for that marketplace. And then we can build both low income housing at the one end and high income housing at the other end. But that missing middle stuff is really hard to do.
Oh yeah. Yeah. I mean, it's just, there's a lot to unpack there, but the first and foremost, there's been so much research. I mean, the two topics that are most well researched are rental housing. And number one, rent control is bad policy. It never works, no matter how many times people try to say this time it's different. And then number two, that filtering is real. And filtering is the process of when we build nice new apartments, you're going to have people don't come out of thin air to spend money on an apartment. Like they're moving up. And so essentially removes what I call legal squatters who are wealthier people renting cheaper apartments. And they're basically paying less than what they can afford and really want. When you build nicer things for them, they move up. And that opens up availability at these lower price points for those who need to find units in that home in that price range, because we don't build that price range because that's not what pencils out. And it's not because of developer greed or whatever. It's just because you factor in the cost of land and labor and materials and everything else, regulatory costs, et cetera. You're going to need rents that are Class A levels to do that. And unfortunately, even if you want to build affordable, you're not going to find land sellers willing to discount it for you. You're not going to find construction workers willing to discount their labor for you. And you're not going to find materials companies willing to discount the materials for you.
I was at a ULI meeting, and it was at a local meeting. I won't say where because I don't want to offend anybody. And I've told the story before on the show. And I was talking to a head of planning for a city, and I asked her how many of the permitting and planning people in the department understood the concept of net operating income. And she looked at me blankly because she didn't know what net operating income was. So the people making decisions about what can be built, what should be built, don't understand the basic economics of the business, and that's scary.
Yeah. No, I mean, I don't know how widespread that is, but I mean, yeah, you have to, I think it's important to understand, like, if you're in the property management business, you need to understand what matters, what metrics and what situations matter to you, to the investors who have entrusted you to manage that property, and not just the stuff that's right in your direct wheelhouse. I mean, you want to understand what moves the needle for the people that are ultimately are are making that investment.
Yeah. Okay. We're going to bounce around, and then I want to go back to kind of where we are in the markets. You mentioned property management, and before we talked about fragmentation, and you gave examples of medical business, and I forget the other example you used. But I want to think about the hospitality business for a moment, because that is not it's a fragmented business from an ownership standpoint, but not a management. Well, it is a management, but not from a flag standpoint. Is that kind of consolidation possible or likely in the long term for multifamily?
Yeah, I mean, I think that's probably a pretty good parallel. I think that again, I think it's harder. We'll always see a little bit of consolidation over time, but I think that apartment investment and apartment ownership is probably going to remain pretty diversified for the foreseeable future and pretty fragmented, much like you said, the hotel business. But there's been a lot of people over the years, particularly in emerging prop tech, who've tried to make the case of, hey, we want to build the Marriott or the Hilton or the Hyatt brand of multifamily. The reality is that's really hard to do for a lot of reasons. However, I do think that it's not so much because of brand awareness. I think it'll be more to do just with efficiencies of scale, that you're going to see these large third-party managers continue to get bigger. There's so many things, particularly in the era of, when there's so much focus right now on controlling costs. I'll give you an example: is if you can have maintenance teams that are servicing more properties within a small geographic area, that allows you to be more efficient. They're on the road less, and you're able to spread those resources across more properties, thereby reducing your overhead. And we could go through 1,000 other examples like that. And so in leasing, it's the same way, right? Like, you don't need the same number of leasing agents per property, especially if it's in the same geographic area. And then, technology and other vendor partnerships, like, those who have bigger scale can negotiate better rates. And so, those advantages, I think, are only going to grow. But I think it's going to be more due, again, to the efficiency side than it really has to do with consumer brand awareness and, a flag like you have in the hospitality business.
I'd be curious if a group like Greystar, over time, if you have a number of managers at that size and scale with the technologies that they can use, then could have levels. One of the fascinating things about the flags is Marriott has brands, and it's not the brands. Each brand's a different level with a different quality expectation. And
Yeah.
at the appropriate level, that level of quality is what you're going to get. And that might be part of what's missing in our business, because it's might be more random.
Yeah, no, I could see that. I think the difference though is, like, when you're booking a hotel, you're not doing a property tour in advance. You're not doing a
You're there
virtual
for a night.
tour. Yeah, yeah. And so, like, when I'm booking, I'm a Marriott guy, and so I know the certain flags I like, and I know that if it's, autograph collection, I pretty much know what I'm getting. If it's
Right.
the Residence Inn and I know I need some extra space, I know what I'm getting, right? I think for apartment folks, I think the challenge is that the renter still really wants to see what it is. And so you can call it different names, but at the end of the day, the renter is going to probably do the research unless they're in a, shorter term arrangement.
Fair deal. Okay, change the subject. We've been in a malaise of the multifamily market from a transaction standpoint, the investment market, for the last 3-4 years. Talk about where we are in that cycle, and I'm less interested in the minute to minute of where we are in that cycle than okay, let's now look at the prognosis going forward. And different real estate sectors, I fear what happens to different real estate sectors, but multifamily, unlike office, isn't going to have a secular change, I think, in terms of going away ish. So, comments about where we are in that part of the business.
Yeah, no, it's a good topic. I mean, I think that we're in the situation where it's coming back, but very slowly. We're well below the peaks, but we're also seeing that capital. There's a flight to quality among renters and among capital. In particular, it's not so much like A versus C. It's really about like getting to quality locations. We're seeing a location
Mm.
bias. I want to be in the higher demand areas, access to not just jobs, but the things. It's the retail, it's the hospitality, it's the restaurants, the better schools, all the stuff, right? And so I think that's what's coming back first, and capital is showing a bias toward that, and we're seeing pricing that's locking in for that. I mean, you're seeing that for the well-located newer vintage deals, that we're seeing deals trading in the fours again. For older vintage stuff and less well located, even the same MSA, those cap rates could be 6 or 7 plus, just depending on what it is. So we've seen a lot more expansion, widening spreads between the nicest stuff and the oldest stuff, which had really tightened out at the peak of the last cycle. So I think that's been the real big storyline. And we're still trying to see where that bottom of the market really ends up kind of leveling out.
And dive into that a little bit more because you say kind of maybe it could be a cap rate of 4, it could be a cap rate of 6. What's the variation of that? What was the variation of that when the cycle was hot? Were the 6s coming down to 4.2? What did that look like? And what defines the thing that gets a 4? Is it age? Is it the level of the property? Is it the specific location and 2 blocks away is going to be much worse?
Yeah. So, and first and foremost, in a healthy market, you should see a comfortable spread between the best locations, the newest buildings versus the worst locations and the oldest buildings. What happened at the height of the of 21, 22 is that spread really contracted, and it wasn't uncommon to even see value add deals, older properties, and subpar locations trading at sub 4 cap rates because debt was so cheap, and that drove a lot of capital into space. And yet a lot of companies just wanted to deploy capital and wanted to be in a certain market, and they got a little bit less choosy about it. And that's stuff that kind of got in trouble. And so those spreads are widening back out. And so what's trading at those fours in the mid, let's call it mid to fours, low fives, is generally going to be stuff that's 10 to 20 years old. It's in the higher income, higher rent parts of an MSA, better access to jobs, just more desirable places to live. But that stuff is going to trade for a premium. But the stuff that's going to be higher again is going to be less desirable locations and older properties in those spots.
And does that mean that Core Plus is back? Because Core Plus 2 years ago was, no, you can't, it ain't going to pencil. No one's going to be interested. But you just defined Core Plus, I think.
Yeah, yeah. I think it's to some degree, but I think what's really changed is it depends on how you define these things as well. But I think what the biggest difference is it's timeline. And today's buyers, like they'll say, especially with Core Plus, they're buying for basis, they're buying below replacement cost, and
Hmm.
some people think that's legit. Others will kind of laugh at it. But regardless, like the strategy is you buy for the basis, and it's that strategy. It's a longer term play, and that's what's really changed. Is you're accepting that first year or two may not be great, but you expect years, maybe year two, but especially year 3, 4, 5 to really carry water for carry the load for the investment.
One thing I've wondered is does the basic business model of the industry go to longer term hold model than what has been typical, which is a 3 to 5 year hold on a value add play and you're going to ride it up? Maybe a more stable long term market has different dynamics and different behaviors.
Yeah, no, I think that's definitely the case. I mean, the short term buyers are pretty much out of the market. I think at this point, everyone's assuming 5 plus years, 5 to 10 years. I mean, if you can sell it before that, great. You really can't. I don't think most buyers are. One of the things you really want to have right now is flexibility on the exit. I mean, you get in trouble where you are in a have to sell period in a tough point in time in the market. The buyers today are those that are better capitalized. Um, not taking on quite as much debt and have a little more long-term view and flexibility on when they need to sell.
What is being built? What their new product is being slowly delivered. And we'll talk about low income housing in a bit. So let's leave that one aside, or specialty asset class like seniors and students. But in mainstream multifamily, is there building going on? Are there green shoots about that? Where and what kind of products?
Yeah. So there is. I mean, the development's still continuing. It's certainly come down from the peaks of a couple of years ago substantially. Today's construction is half of what it was a couple of 2-3 years ago. What's out today is it's basically it's all about what can we get to pencil out, and that's typically going to be lower density garden, low rise properties. There's a lot of value engineering going on right now to try to figure out how to make deals that actually work, and so you're going to see more kind of in industry vernacular, sort of like A-minus type deals where they're certainly nice, good properties, but they're maybe cutting back on some of the amenity wars that we've seen previously. And also, I think it's more suburban in nature than it has been for the last 15 years. And I say suburban also, I mean like really generally where you get a lower land cost. And so maybe attacking areas that didn't see as much supply previously. I'm gonna give you one example, like Equity Residential. We talked about them earlier. It's like, they're getting back into some of these Sunbelt markets. They're building. I had Mark Perel, their CEO, on my
Yeah.
podcast a few weeks ago, and he said they're going to start 2 projects this year, and both of them are in like kind of exurban Atlanta, which is very different from their traditional profile, but that's where they see an attractive opportunity and they're willing to test that business model to see if it works. And so not that everybody's doing the exact same thing, but I think that's sort of emblematic of the shift right now.
Right. And so that shift is different than close to transit. That would be a different theme. Okay, I'm going to be close to the subway stop. Even if that's a far out subway stop, you might call that urban or suburban, but not exurban.
Yeah, I mean, but everybody still likes those sites. The problem is that
They don't pencil.
the density stuff is higher cost and it's harder for those deals to pencil. And the perception is still that I can buy much cheaper than I can build in those locations. And so until those values come back up and the buy to build math gets more favorable, it's going to really limit how much stuff gets built in those locations.
Also, in those locations, there'll be more exactions from government to say, okay, cool, now we have to have a certain, higher percentage of low income housing, which
Yeah.
might not happen in the ex-urban areas, as you call them.
Well, yeah, and that's another thing too, is that a bigger share of today's starts are going to have some affordability component in it, whether it's LIHTC or if it's like a workforce housing program with some type of restriction on rents. Those type of deals that subsidize property taxes is number one cost. Those deals are more likely to pencil out. And by the way, that's not easy either, but relatively speaking, that's a larger share of today's construction than in years past.
Okay, so let's stick on that one for a few minutes, and particularly kind of low income housing, either formally subsidized or property tax abatement or other forms of workforce. When you said we were at half the volume that we were at before the downturn and before the overbuilding downturn, the percentage of that half the volume that is low income housing.
I'll give you some stats. Like historically, of all multifamily starts, and this is some data that Yardi maintains, but prior to these last 4 or 5 years, somewhere around 12% of all starts were going to have the capital A affordable, meaning there's some income restricted rent component to it. Today, that number is closer to 18 or 20%. And so it's just a bigger share of the starts because that's what's, kind of helping these deals pencil right now.
But think about seniors housing, student housing. Let's talk through the various subspecialties in what's still the apartment business.
Yeah, I mean, I think that I in the senior housing space, I mostly look at the independent living or age restricted housing. Obviously, you get the whole care spectrum that's beyond what I really can look at, and that's tracked a lot. That's managed and owned a lot pretty differently from the other things. But yeah, we've seen the senior living space has been interesting because on the one hand, the demographics have been just incredibly supportive. On the other hand, I think you're also seeing that seniors as a whole are choosing to hold on to their homes more than people thought. And so I think it's been a good space, but it's proving that it's not like you can just do it and you're going to be printing money. Like this should be obvious, but I'm not sure it was a handful of years ago, which is that, you want to be really thoughtful where it's going. I think in particularly where we've seen it be successful is, really locating in areas where the grandparents could be closer to the grandkids, maybe live there seasonally. That stuff tends to do pretty well. It's a slower lease up, but you get a higher rent premium for it. But the other factor too is when you get to a lot of these like more mobile active seniors, a lot of them don't necessarily want to live in senior housing per se. And so we're also seeing, I think, a pretty good share of seniors living in conventional apartments in urban locations. And last thing I'll say on senior as well is that I'll kind of talk out both sides of the mouth here. Well, it hasn't been this tidal wave of demand. We're going to have a lot of population growth over the next decade and people who are 70 plus. And so you don't need the share of the senior adult population renting to go up materially.
Uh-huh.
You can keep that same share renting stable and you're still going to see, probably hundreds of thousands of additional seniors entering the apartment market purely as a function of the size of that generation, right?
Mm-hmm.
And so I think that's going to be a growing factor over the next 10 years, both for senior living and for market rate conventional.
We had Deb Cafaro from Ventas on the podcast about 6 months ago, and she talked about how strong their sector is, how strong their business is. And among all the strength, I said, how much development are you doing? And she said, none. It still doesn't pencil. The dynamics are great. NOI is increasing, but it's still not increasing enough to justify, at least for her company. I think Welltower is doing some more development, but that space is fascinating. And a lot are age in place kind of senior housing in apartments. It's a good place to be because you have the density and you get some services there.
Yeah. Yeah. No, I think, again, there's definitely a strategy there. But yeah, it's just, again, being very strategic what you're doing, of course, like anything else.
Mm-hmm. How about, do you look at student housing?
Absolutely. Yeah. I think, I don't fancy myself a student housing expert, but certainly keep track of it. I mean, I follow guys like Carl Whitaker who do a really good job tracking it. But, I think what's interesting about student has been very countercyclical from the conventional marketplace over the last 6 years since COVID, 6, 7 years. It seems like ages ago now, but it wasn't that long ago when these campuses were shut down in
Mm-hmm.
some cases for 2 years or a year and a half. And that left this huge cloud of uncertainty over the student housing market at a time when the conventional market was booming and therefore doing a lot of construction. And so by the time that the student housing market, became more clear that, hey, the people still are going to live on campus, people are still going to school on campus, we're not going to full-time Zoom education. By the time all that became obvious, rates were starting to trend back up.
Mm-hmm.
And they sort of missed the window to build a lot. And so while we saw a ton of conventional construction, we really didn't get a lot of student housing construction. And so what we've seen as a result of that is that student housing rents, particularly at the major and kind of brand name universities, have done really well. Now, the other factor for student housing is that the demographics are far less favorable today than they were 10 years ago. But what it's doing is it's creating kind of a winners and losers scenario where the Power 4 schools, the big names, like they're still doing great, enrollment growth. Some of the regional schools are not. And we're seeing enrollment declines and weaker demand for student housing in those markets. But again, it's been a really good story with low supply and kind of winning over the demand that's there for the kind of brand name schools.
I wonder what immigration control and less foreign students will mean for that business. Have you looked at that?
Yeah, no, it's definitely having an impact. I mean, the obvious one is Boston. We've seen a real slowing in the Boston market, and Boston's obviously Boston's a market that has a
School too.
lot of major and small universities, and some of the, it's hard to track this precisely, but there's been a lot of reporting up there showing that there's just been a reduction in demand from international students, and that's impacted the housing market there.
Right. And one thing it does, it's back to flight to quality. It might be flight to quality for larger schools, but it also might be a flight to quality in student housing for those properties closer to campus.
Yeah, and that's a great point. That's been true for a while now, which is that, one of the things that, that I mentioned Carl Whitaker, one of the things he always talks about is that he tracks performance based on radius to campus. And yeah, the closer you are to campus, the higher the rents, the better performance, the higher the demand in those areas for sure.
Right. There's currently no public companies in student housing. We're doing a search to help one that might soon become one. So we've been diving deep in the meaning of student housing right now. So it's fascinating.
Yeah, we had two. They both went away.
I know. So we'll see what happens. Okay, so with that brings us to other drivers in the business. And one of the headlines of the business and the growth areas has been both SFR and BTR. They're related but different. And now there's a pause, there's a freeze. What's going to happen there? Talk about both what drove that to become a big market And then what the heck's going on right now?
Yeah. So, oh man, it's such a big topic. So I guess the quick version of this is that, the SFR wasn't even on the radar until the great financial crisis. And then you had, and people forget this, the crazy people forget this anyway, but like it only became a thing 'cause you had, literally millions, no exaggeration, millions of homes that were foreclosed, bank owned, had to find something to do with it. And there's meetings in DC with people in power trying to figure out, hey, what do we do with all these houses? And then we saw institutional capital at the time was being hailed as rescue capital to buy these homes at a discount in bulk that no one wanted to buy individually because no one was buying houses back then and rent them out. So we created an industry overnight. And what's interesting is that they really pulled back on buying really since mid 2010 to 2016 as the home buyer market came back. And we've lost 1 million rental homes to home buyers since that time frame on net, but most people aren't aware of that. So then the capital started to shift toward build to rent, and that was a whole kind of it was a nascent industry. There's always been a little bit of it, but it's never been kind of a mainstream thing. And we've been building quite a bit of that particularly over the last 5-6 years, started to ramp up more and more and more. And so that's been a case where it's like capital saying, hey, this is a more efficient play. It's easier to manage. It's centralized. We could put them all together. We could build the same thing, make it easier to maintain, same appliances, same thing, same repairs, we know what to do. And then this road to housing comes about. And it's actually been around for 2 years. Then, long story short, they decide to take what was a good bill, attach this ban to it, and Section 901, and that's made what was the road to housing now the road to less housing, as many of us have come to call it. And it's crushed the development pipeline for build to rent. And so now there's just a big cloud of uncertainty over that entire market.
And build to rent, let's play with that for a few minutes, is I want to build, I'm a multifamily developer. I want to build housing that serves people who want 3 bedrooms. They want a 2-car garage. They want a backyard. Can we serve that population who can't afford to own a home? And that's a deep market who wants housing options. It's not
Absolutely.
evil, and neither is SFR, which we'll talk about in a sec. But I wonder where the thought that this might be a bad thing comes from.
Yeah, I mean, I'm always just I would say annoyed by the number of people who their perception is, I don't want to live in this, so therefore nobody should. And it's such an arrogant, sick way to see the world of like everybody should think like me. And I think that's obviously wrong. And there's obviously demand for these homes. And that's what they are. They're homes that renters are living in, and that's what they prefer. And it gives them access to a newer home with central management at a lower cost than what they would otherwise have to buy. And so, that's a win. But the perception coming out of DC, I think most of the people who don't know what they're talking about, and frankly, I think even if you read the legislation, it's very obviously written by people who, I'm not just trying to be insulting or make a point. I'm just saying, like, you read it. If you know the space and you read that bill, it's very obvious to you that these people who writing this law have no idea what they're talking about. Like it's very uninformed and hurried and rushed. And that's very unfortunate. But their perception is that, hey, we should be building more homes for sale, not for rent. And their perception is that these builders can all just build them for sale. But that really reflects a lot of ignorance about how this business works. It's funded differently. It's built differently. It serves a different demographic. And you talk to these build to rent developers, they're not going to build for sale condos. That's just not their business. They'll be if you take it out, there's going to be less housing in total.
I think it's back to the point of demonizing institutional ownership, demonizing landlords, demonizing private equity. And sometimes each of those 3 are demons, but most of the times each of the 3 have enlightened self-interest to behave in such a way that their businesses will last long term.
Yeah, absolutely. And I think even on the private equity thing, it's always funny to me. Like, sure, it's totally legit to point out the ills of any industry. It's not. I'm not saying let's just all pretend it's always everybody's just perfect and good, right? There's going to be good and bad, and there's people who are good at this. There's people who aren't as good at this, and that's fair. Call balls and strikes. We become so jaded. It's like I look at some of the people who just assume that anything private equity is bad, and they forget to point out that wait a minute, who do you think just funded the million plus units that we just built in these last 2 years and actually put downward pressure on rents as a result? Well, it was a lot of private equity, actually. You know what? It did. They've been, I know this is kind of wild to say, but they've actually been part of the solution to affordability because they're creating more supply for people who need more housing. And so I think it's important to acknowledge their role in funding construction and supply relief, because without it, we're not building as much housing.
It's an interesting dynamic. You and I know about this stuff, but these mythical people who you're talking about, the decision makers, don't know about this stuff. But one thing we know about private equity is that 15 years ago, it was largely buyout money, short term money, vulture money, if you want to use a bad word. And now, largely, those big private equity players have different pools of money. And the money that they're putting into, say, the apartments and even into low income housing is long term money. And it's dollars from teachers and public workers and pension funds and stuff. But they're looking for long term hold with less volatility at a fairly low coupon rate.
Yeah. Yeah, no, it's yeah, I mean, it's all these, but also too, it's people forget too, it's like we make pension funds a bad term, but you know what? Who are the beneficiaries of a pension fund? It's not, the guys living on Billionaires Row in New York City, right? It's retired teachers and firefighters and police officers. Like, it's who's invested in
Right.
these projects. And I think people forget that piece of it as well.
So let's come back to where we started the conversation, which are questions about regulatory risk to the industry and the different segments of the industry. And if there's an attack against SFR and BTR and an attack against institutional ownership, the apartment industry writ large may be the next. And I think there have been requests to some of the larger owners to provide information for something. There's also the real page lawsuits that are related to this. How do we make sense of all of that? How does it relate to those lawsuits? And let's start there, and then I'll ask some questions about behavior and what the industry could do to kind of reclaim its name in the business world or in the popular world, not the business world.
I mean, regulatory risk is now front. I mean, I think the best way to say it is that I think pre-COVID, regulatory risk was something that every investor probably mentioned in, size 6 font in the back of an investment packet
Mhm.
among risk disclosures, and these potential things can happen, right? I think, it's listed next to all kinds of other things. Like,
Actually, let me
now,
argue with you for a sec. I'm interrupting you,
sure.
but I'll argue.
Yeah.
About 10 years ago, so it's before that time period, we did a search for one of the REITs that we've mentioned a few times. And in the job description for the regional head of asset management or the West Coast lead was be able to talk to public officials.
Yeah.
And maybe that's because California was leading the way in terms of an annual rent control goal. But so the industry's been aware of this for a long time in a deeper way
Absolutely.
than I had thought.
That's a good caveat, and I think better way to say it maybe is that it's always been perceived as kind of a California and New York sort of
Fair deal.
issue, but now it's more broad. I mean, you see the first, I think, wake up call is you see St. Paul, Minnesota, like in the heartland, like they pass one of the most a rent control measure that was literally probably written on the back of a napkin at a restaurant and got voted and approved with very little thought, and is now having severe consequences on the supply pipeline there. You've seen Montgomery County, Maryland, one of the most affluent counties in the nation,
Yep.
pass rent control that's completely annihilated the construction pipeline. You've seen Massachusetts now looking at this as well. Then you've also seen states like Colorado. It's not rent control, but they're doing things like, they've changed like their screening limitations. I don't know if this is Denver or the state, but anyway, they've things like just you should be able to qualify just like for a mortgage, just for a rent. The city or the state, in its infinite wisdom, say, you know what, like you shouldn't tell people they need to, have 30% of income to rent ratio on max. It should be 50%. I'm just making up. I don't know the exact numbers. But what do you think happened? Well, now they're forced rent. People can't afford it. There's more delinquency. And they're mad when there's eviction filings because their people can't afford to pay the rent. So, it doesn't make a lot of sense. We've seen other issues too, where you're seeing things like, we've always had problems with, in this era of high connectivity, we've seen third party, Wi-Fi providers have been inconsistent. So what does the industry do? Finds creative solutions for like bulk Wi-Fi rollouts. We're going to manage it ourselves. It's available instantly the day you move in.
Right.
But then the federal government says, oh, wait a minute, like that's not right. Like we need to have all these, well, having better service at a better price isn't a good thing for the renters. Like we're sort of losing sight of, and the junk fee issues and all this stuff. It's just one
Yeah.
thing after another. So it's really changed the game for sure.
So let's bust some myths and then also think for the industry. So in the run up, let me rephrase the question. In the run up to the high time 6 years ago, did the industry overly take advantage of the run up in rents? I mean, were we greedy? Were we crazy greedy to make this level of backlash common?
Well, I mean, I think it's important to remember that it's like that was a period where it was high inflation for everything. I saw on social media yesterday. I saw some like there's been a whole thing about eggs, right? The cost of eggs went up not like crazy. Now it's crashing, and so somebody posted this chart showing the price of eggs over time, and they added these labels like egg producers getting greedy, egg producers now less greedy, egg producers getting greedy, egg
Uh-huh.
producers less greedy, not greedy anymore. They give up on greed. It's like now we're getting generous, and the whole joke is obviously it's like it's not a greed thing, right?
Right.
It's just supply and demand, and a lot of
Supply and demand.
expenses went up by double digits too, and you're paying more for taxes. Insurance costs have doubled and tripled in some markets, and payroll costs have been one of the highest drivers of cost, and that means people are getting paid more. And so those things aren't those things. They have to account for those costs as well. Not that apartment owners weren't doing well, of course, but that's changed over these last few years. It got more challenging. But the point was like, there was a broader thing at play. Now, also, let me also just say this though. I think like you look at issues like the whole junk fee argument. I think there were cases that everyone's seen where it's like we're charging kind of vague fees that aren't really clear what you're getting. It's mandatory. It's like an amenity fee or something. Like those type of things will get you in trouble. And I think that's what's kind of bit the industry in the tail a little bit.
Mhm.
And so I think that it's really kind of made it clear, whether, and I'm a consumer as well. It's like, I don't, if I'm going to pay a fee, what am I paying for? Is it a
Mhm.
real additional value? If so, great. If not, not so great. And so I think some of that stuff we probably should have been more thoughtful about. And now it's not so much about, honestly, it's not even so much about the fee. It's like, hey, just like if that's part of what you're going to cost is your
Put
mandatory
it in.
cost of renting, just put in the rent. You're not fooling
Right.
anybody. Just put in the rent.
I was fooled a couple weeks ago. I stayed in a hotel and it was a 50 buck a night amenity fee. And they said, "Hey, look in the small print of when you did this on Expedia." And indeed, the small print said there might be an amenity fee or there was an amenity fee and it was going to be 50 bucks. I hadn't read that. I just, I bought the thing. Ticketmaster does the same thing. So we're all wrapped up in that backlash
Oh
in the
yeah.
business.
Yeah, all the nice hotels now too. It's like there's an amenity fee or whatever they call it, and then it's like, oh, here's a free drink coupon as part of your amenity package. It's like, yo, thanks a lot.
And I'm not staying for breakfast. I actually came to
Right.
town so I can have breakfast with someone. I'm not having your free breakfast bar, which, would depress me. So it's crazy. Any other comments about the Real Page series of suits? It's not just Real Page, but I'll use that word to describe the rent optimizer lawsuits. Does that get settled out? Is that in the rearview mirror because everyone's behavior has changed and we're still just cleaning it up? Or does that have meaning going forward?
It's hard to predict these things. I mean, I think obviously the big one got, I believe, largely resolved. That being the DOJ case, and so that I think that helps put the biggest one behind the industry. But I mean, it's unfortunately, there's a mix between politics and litigation these days, so it's hard to really predict where these things go. I think that ultimately it's one of those. It looks like we're on the other side of it, but you just never know.
Okay. It's been sticking with us now for a bunch of years. I was at a dinner with friends about a year ago. There are 4 lawyers in DC, and they said, "What is this thing?" And they were describing it, and they said, "This industry's crazy." And it was lawyers. They know I'm in the industry, but not really. And so it was just a topic of dinner conversation. It was a nerdy topic of dinner conversation, but they went right at our industry talking about price fixing was their words for it as attorneys, and they were like, "This makes no sense." So it was fascinating.
Yeah, and I think that's a good example too. Doing like myth busting. I think what's challenging is, and without talking about the specifics here, but just more broadly, when you read sometimes what people perceive, and you see sometimes people talk about social media or in a media article, it's like, well, yeah, if that were true, that would be bad, but you're not actually describing what is actually happening,
Uh-huh.
right? That's not, what you're saying is indeed bad, but that's not what
What it
actually is
is.
happening here, right? There's a disconnect, and that's really unfortunate because that the misinformation I think is really fed into a lot of uh,
Okay, you're gonna be our national myth buster. Before we
yeah.
wrap up, which we have to do in a minute, any other myths that you love to bust?
Oh man, there's a whole bunch of them. I think one of the most important ones though is around the relationship between renting and buying. And I will tell you, I think all throughout the industry, the media, the policy world, there's this perception, even the industry, there's this perception that if one does well, the other must be doing poorly, like they come at the expense of the other. But this is just not true. Like the reality is that a rising tide boosts all ships, and then with few exceptions, generally speaking, when the home buyer market is strong, the rental market is going to see more rent growth and it do be stronger. When the rental market is strong, it's usually when the home buyer market is strong. That was true in 21 and 22.
Mm.
It was true in the latter half of the 2010s decade. It was true in the housing bubble period in the mid 2000s. In terms of the strong parts, and even when the housing bust, obviously that was a bad market for the rentals in the 2008 to early 2010s period, and it's been challenging these last few years. There was you could go back and read. I've been wrong about a lot of things. If you go back and look at the tape, when mortgage rates went up and home buyers started pulling back, everyone's like, "Oh, rentals are going to boom," and I was out there saying, "No, they're not." And sure enough, I mean, I get a lot wrong. I'm going to pat myself on the back for that one because I
Right.
knew I was going to be right, and that's what happened. And I've even told in the years past, I will tell investment groups sometimes and say, "Look, you need to be cheering for a stronger for sale buyer market, for sale home market," and because a rising tide boosts all ships. When you buy a house, that triggers more household formation, more consumer spending. You're hiring contractors. You're going to Home Depot. That means more jobs, yada, yada, yada. So you're going to have more turnover, but you backfill those units faster, usually at a higher rent. And so everybody wins. And so I think that's one of the biggest misconceptions across the industry, and again, and across the general public. And again, I would tell everybody again, it is in the entire economy's and the industry's best interest to see a better home buyer market.
Right. It's interesting because you think of a 35 to 65% switch between rental and ownership, or is it 60-40 and it bounces between these numbers in some band, and there aren't a winner and loser between the two. It's not the relevant thing to look at as you're describing.
Yeah, it's not the rate. Homeownership rate has been always in a fairly tight band. In fact, today's homeownership rate, contrary to public perception, is still well above the long-term average. The issue is really more about household formation. You can have homeownership rate can go up, but if we're forming more households, rentals can still do really, really well.
Well, we should talk about the birth rate. Any comments about the birth rate? Any myth busting around the birth rate and how that will affect stuff?
Yeah,
And will
if
we
we do this,
replace ourselves?
if we do this podcast in 20 years, that's going to be a big deal.
Yeah.
So, I guess, the point being that you look at the biggest drop off in the impact of the birth rate are people who are now, 5 years old and younger, give or take.
Mhm.
And so at some point, if you don't get additional immigration, legal immigration coming into the immigration reform, I should say, if we don't get, a pickup in the birth rate, that obviously could impact housing demand in decades to come. But 5-year-olds don't sign leases, don't buy homes. So in the
Not yet.
short term, it's not the most pressing issue.
Well, if you think about the relationship between immigration reform and birth rate, and if we keep tamping down immigration and then birth rate stays low, our country will go into a Japan-like malaise because the economy can't grow unless AI comes to our thing. Okay. Any comments
Yeah,
about AI? Any
no.
myths on AI?
I mean, honestly, AI changes so fast. I'm not an AI expert. I'm not going to pretend to be one, but I would just say two quick thoughts. I think number one is that I would remind people in the big picture, the American economy is resilient. Like we overcame a little thing called the Industrial Revolution in the 1800s. We overcame the personal computer era, the internet era. It's also too eliminated a lot of jobs and, things like data entry, administrative assistance roles, things like that.
Right.
So the economy is resilient in the long run. And I think it just further expedites the shift toward a more services-based economy, but it's going to have clear disruptions as well. And we're all seeing that, in the short term, some of it may be even slightly exaggerated, but, it's real. And I think one impact it's having, it doesn't have attention, is that it's not just that AI, it's not necessarily always that, AI certainly is displacing some jobs, but also I think the other bigger factor for a lot of companies, it's not that AI is actually displacing the jobs yet. It's that the executives are thinking before they open up job recs is AI do this. And let's look into that. And so even that thought process, that can delay hiring decisions because you're going to first look at, do we need this job anymore in the era of AI? So there's certainly an impact. But again, I think in the long run, we figure it out.
I have a complaint about Economist. Then we're going to wrap up. I'm going to ask my last question, but I have a comment before this because the difference between a macro view and a micro view is really huge. And in the macro view, our economy was expanding in the last 20 years in a big way, right? It's great. It's great. It's great. It's amazing. And the macro view kept proving that. But then the micro view of those people dislocated, you can just use those words, I think, the micro view of the dislocated becomes really tough. And So the dislocations have to be dealt with while the good things are happening at the big picture. And if we don't know how to do that, we're going to have the level of unrest that we've had. Sorry, I take
Yeah, that's totally
everything
fair.
back
But I
to
would tell you
politics.
the thing that's encouraging right now is that we often hear the term it's a low hire, low fire environment. And so it's not so much that I mean we've all seen some headlines of certain but companies, but a lot of that is eliminating open job recs, and we've not seen a lot of like increases in the actual firing numbers, and in the tech sector, it seems like every time there's a tech company that lays off people, it's like they all seem to get jobs the next day doing something else. And so it has been, again, pretty resilient. And again, I know there's exceptions, and I think we need to be mindful of those people, to your point. But so far, that hasn't been the real story on a macro basis.
Fingers crossed. Last question on leading voices, which this is a good segue to. Last question on leading voices is always your advice to a young person coming into, say, the apartment business. And given those potential changes in the world, what do you advise a young person these days?
Yeah, it's a humbling question because I think part of me still feels like I'm a young person, but I guess I'm reconciling the fact that I'm not really anymore. So it's humbling though. I get people reaching out to, or still in college or coming out of college looking for advice, and so I try to be thoughtful about that. I think a couple of things. I think that obviously there's a perception that younger people coming out of school understand how to use tools like Claude really, really well and could make us better what we do. And obviously, they're not teaching Claude in business school, but I would say that given the amount of, especially in our industry, like, analysts are using Claude a lot, expedite decision making and, building analytics, things like that, in the way that's like when I was coming in, like it was like my generation of millennials, it's like, wow, these guys know how to use Excel and build formulas and like macros. And like, that's a big deal, right?
Mhm.
And so I think this next generation, it's obviously taking it the next step further, like showing you can add some value there. And I think also too, I would say as well is that I think that it's really showing that, or really establishing that intellectual curiosity and a real
Mm.
that you can bring value right away, and not just I don't know how the best way to say this, but that you've got something to bring to the table day one is maybe the best way to say that. So I could probably go on for a while, but that's a couple of things that are top of mind.
I'll say another thing and see your reaction to this. Come to the apartment business, young people. The apartment business is an ecosystem unto itself. There is a relationship nature to the business, unlike healthcare, I think. Unlike high tech, the relationship side of it is wonderful, and you can navigate and build a career thoughtfully in this particular ecosystem, I think, really well. It's an exciting place to be, and it serves people. Any
Yeah,
comments to that?
you're absolutely right. I mean, everybody who's it's one of the things that's really powerful. I would tell you, it's like you talk to anybody who's 35 plus. Most of them stumbled into the apartment industry in one way or the other, unless that was part of the family business they were in. I think one thing that's changing now is that those who've come into their careers or gone to school in the last 10 to 15 years, they've entered the workforce in a period where apartments were the most favored real estate asset class, and so that's changed things a little bit. It used to be office and retail were the sexy ones. Now it's the residential categories. And so I think it is a little bit different where younger people are going to more likely be perceived that office is a high risk sector, and multifamily is the place to be. So it's an easier sell today than it was 15, 20 years ago.
I think so true and resilient because it's going to be here in 20 years and some of the other sectors will keep changing in a deeper way, but multifamily will have a level of consistency that makes good sense. Sounds like
Absolutely.
investment too. Hey, Jay, thank you very much. It was a pleasure having you on the show and having a podcaster on the show too. So this is great. Thank you.
Well, thank you for having me. I
We'll
enjoyed
keep
the
talking.
conversation.
Okay. Bye-bye. I hope that you enjoyed today's episode. Please remember, if you're enjoying Leading Voices, to share an episode with a friend or get them to subscribe. If they're podcast wary and not sure how to find and subscribe on their phone, go ahead and take their phone in your hand and subscribe for them. And add another few of your favorite podcasts to their list to get them started. They'll thank you for it. You can also find episodes of the show on our website, which you can find at zrgpartners.com/leadingvoices. And if you have comments or discussion about this episode or Leading Voices in general, or if you're seeking help in real estate human capital solutions, recruiting or consulting especially, please contact me at msleppen@zrgpartners.com. Thanks for being a listener to Leading Voices.